Hi there, welcome to The Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Canada's GDP edged higher in January, driven by strength in goods-producing industries. Gains in mining, quarrying, oil and gas extraction, construction and utilities more than offset shrinkage in manufacturing, retail, trade and finance and insurance. Retail, trade and finance and insurance actually saw increases, while wholesale trade, transportation and warehousing posted declines. Preliminary data points to a 0.2% increase in February. Unilever is combining its food business with spice maker McCormick in a $44.8 billion US deal. The transaction will give Unilever control over the newly formed global seasoning and condiments company. McCormick will play the Anglo-Dutch company in cash and stock for most of Unilever's food business. The transaction will leave Unilever and its shareholders with a 65% stake in the combined entity. In a social media post today, U.S. President Donald Trump said countries short of oil should either buy it from the U.S. or go to the Strait of Hormuz and take it. Trump also reiterated his disappointment with what he calls lack of support for his war in Iran, telling allies they will have to start learning how to fight for themselves. This comes as U.S. and Israeli attacks on Iran and then Tehran's retaliations across the Middle East continue to damage energy infrastructure in the region. And there is a look at U.S. futures edging higher, but it's been a tough year and a tough quarter for investors. Wall Street Journal says, in fact, for the U.S. market, it's been the worst quarter in 4 years. And let's have a look at the TSX, how it traded yesterday. Our market off its highs, just like U.S. equities, but getting something of a boost yesterday from higher oil prices. Speaking of oil, let's see how it's faring today. And you can see it's pretty flat, but almost $103. And of course, we're repeatedly hearing commentary that in the real market for oil, not the so-called paper market, prices are far higher. So we have North American stock futures or U.S. stock futures pointing upward today. There are reports that President Trump has told aides he is willing to end the war on Iran without fully reopening the Strait of Hormuz. But there's plenty of uncertainty hanging over the market. Let's get the latest from Michelle Connell, president and owner of Portia Capital Management. Michelle, thanks very much indeed for joining us.
Thanks for having me, Andrew.
What are you paying most attention to when you wake up in the morning? What do you search for on your phone first these days, Michelle?
It's really hard, isn't it, when every day there's a different headline, there's a different tweet from Trump. So you're just having to go with the volatility and focus on the long term, not the short term and all the noise, Andrew.
Are you seeing opportunities right now in stocks that you've long had an eye on but are now cheaper?
Definitely. For instance, I'm a tech person by background back into the late 90s. NVIDIA looks very enticing here. The end of January, NVIDIA's PE or price to earnings ratio was 40 times. Since then, it's been cut in half. This is the first time in quite a while its forward price to earnings ratio is almost equivalent to the S&P 500. But keep in mind, NVIDIA keeps taking up their revenue estimates this month or in March, earlier this month. The CEO came out and said they easily are going to be able to sell $1 trillion in artificial intelligence chips between now and the end of the calendar year 2027.
$1 trillion just in the AI business?
Yes, sir. Mm-hmm.
It's interesting, though, this Gulf, the crunch on raw materials from the Gulf, and not just energy, but aluminum and also helium. You mentioned it, I think, or you've been keeping an eye on that. Helium is vital for making these semiconductors.
Yes, you're right. Helium is imperative, but also natural gas. And that natural gas and helium is being turned off to Asia, and that's imperative. 90% of artificial intelligence chips are made in Taiwan, and they need that helium and that natural gas.
Yeah, apparently they use the helium for cooling the chip making tools, and also, of course, for keeping MRI scanners going. Yeah.
Exactly.
Yeah. NVIDIA, are you attracted to the other semis, broadly speaking, or would you tend to focus on NVIDIA right now?
I like Broadcom as well. It focuses less on the general AI, which is more of NVIDIA's strategy. Broadcom has the ability to provide to their clients customized artificial intelligence chips. I also like Taiwan Semiconductor because they're the largest fabrication facility in the world. And again, they're the ones that are producing the majority of the artificial intelligence chips.
What about bonds? I'm not sure what kind of portfolios you manage, but if it includes balance mandates. But what about the US 10-year bond right now? Would you be a buyer of that, say, with a time horizon of 5 years?
I do have a lot of balanced mandates. My larger clients are foundation in the south of the United States. I'm watching bonds. There's been a lot of volatility too this year, right? As initially we thought rates were going to be cut, and now it looks like with the increase with inflation, bonds probably won't have the decrease in interest rates that we thought. So I think owning duration or maturities that are shorter in nature, I wouldn't go out past 5 to 10 years.
When you sit down with the people running these foundations, the people you run money for, I'm guessing they're a conservative bunch. They've got a time horizon of decades in some cases. What do they say to you about tech stocks? Do they say, hey, I'm worried about an AI bubble?
It's been an education process because we also own a lot of alternative investments, and the largest portion of those alternative investments are in technology, venture capital, private equity. But we've been very strategic and thoughtful because of the risk potentially in those type of investments. So we have smaller positions in them so that if something does really well, like last year we had CoreWeave, and we also are looking forward to Anthropic going public this year in portfolios, but small positions so that when they do well, they'll add to the outperformance. But if they don't do as well, we're not going to get hurt as much, Andrew.
Let's switch to something more old-fashioned, gold. You like the look of gold miners right now. Of course, there has been disappointment among gold bulls that gold hasn't done better during the current war in the Middle East.
Well, I think there may be two reasons here, right? Well, maybe three. Gold had done extraordinarily well through 2025. The US dollar has regained some strength, and so gold has been a haven from the US dollar. So I think we've seen some relief there. But long term, I still like gold. We're going to have inflation for a long time. We have deficits in most countries, especially in mine. And so I think gold is a nice place to look at right now. A lot of gold miners are off 25%. So I think there's some opportunities there. And with gold miners, you have some operating leverage, meaning that you have more upside as they become more productive in those mines. So I would look at maybe some of the gold mining ETFs so you don't have to worry so much about the individual mining company itself.
Right, because a pit wall can collapse in one of their giant mines, and then the stock's under a cloud. Leave us with a final thought, Michelle. The market, U.S. market, as of yesterday, was down about 7% this year. Do you think, well, it depends really on what happens on the Gulf. I was going to ask you, do you think this will be a negative year for stocks?
It depends on how long we're in this situation, right, Andrew? I think if we're able to get out of it in the next 4 to 8 weeks, that our earnings won't be hurt as bad in North America or in the emerging markets. But the longer that we stay in this situation, the longer that we're going to have upside to inflation, and that's going to take away profitability. That being said, before this happened, most companies were looking at earnings increases of 11 to 12% with the S&P 500. A lot of tech companies, and going back to NVIDIA, revenue increases of 70%. So I'm a long-term optimist, and therefore I don't believe in timing the market. My sister actually called me last night and said, should we get out? And I'm like, no one can time the market. I mean, that's why cash is for opportunities. It's not for timing.
I like it, Michelle. Thanks very much. I have to ask you, Portia, is it after the character in Shakespeare in Merchant of Venice? Is that where you got the name?
Yes. Yes. I Brit Lit major in a prior life, love Shakespeare, and Portia was a heroine of ethics and justice.
Yes, and she's a canny character, a great character. Thanks very much, Michelle. Michelle Connell, president and owner at Portia Capital Management. Okay, coming up, another broader look at the markets, and we'll also hear why there are fears that a prolonged near closure of the Strait of Hormuz could, according to some projections, push oil prices close to $150 or even $200 in the next few weeks. Okay, let's have a look at markets around the world and some crucial commodities. There are the Asian markets, and higher fuel import costs are stoking inflation fears in nations such as Japan and South Korea, which are entirely dependent on hydrocarbons from abroad. And we hear that there's something of a scramble for fuel in Asia right now with that shutoff of the Strait of Hormuz. And let's have a look at Europe. An extraordinary political story there, where the Europeans, as Bloomberg puts it, are hardening their stance against the U.S. attacks on Iran. Spain closing its airspace to U.S. aircraft, and Italy denying U.S. military planes permission to land at a base in Sicily. And U.S. President Donald Trump not happy about that. Let's see how things are shaping up in the futures market. So it looks as though we are going to get an optimistic open for stocks today. President Trump indicating that he is open to actually ending the attacks on Iran, even if they don't open, if the Strait of Hormuz is not reopened. And of course, Iran, though, raising the stakes here, hitting a fully laden Kuwaiti oil tanker off Dubai, and that's during fresh attacks around the Persian Gulf. Let's see where the TSX finished the day yesterday. You can see it slipped about 0.1%. This month, the TSX is down 7%. The S&P 500 is down almost 8%. And let's have a look at the metals now. Copper. We know that disruption in the Mideast actually may raise costs for copper miners because it could cut off the crucial supply of sulfur used in the copper industry, and that may tend to increase prices. Gold hanging in today, up 1% or so. Let's check in on Alberta's benchmark grade of crude oil, Western Canadian Select, and it is higher right now, almost 3%, according to our latest quote on that. And let's have another look at crude oil. You can see oil is now pointing upwards very marginally. So far this year, wow, I can't believe it, WTI crude up 80%, but Brent crude is up 93%. We've heard commentary that WTI crude is relatively undervalued, or the futures, the paper market. I'm just looking here at global or European/global prices for natural gas soaring with the cutoff in LNG. Year to date, though, New York natural gas down 20% because, of course, the natural gas market is still balkanized. It's not as global as oil, but it's still harder to move natural gas around. We heard a prediction that a prolonged near closure of the Strait of Hormuz could push oil prices to the range of $150 to $200 in the next few weeks, and of course trigger severe global economic fallout. We got a perspective from FG Nexenteca, Chairman Emeritus at Feridun Fasherhu in a Bloomberg interview this morning. Let's have a listen.
Markets are moving by sentiment, and by Trump's words, it can go up $10, $15 and come down $10, $15. But the fact really is that every week, 100 million barrels of oil is not going through. And every month, 400 million barrels are not going through. So within a period of time, these losses to the market will be astronomical. And if we continue this for another 6 to 8 weeks, the prices will go through the roof. It doesn't matter what President Trump says.
What is going through the roof? Are we looking at $200 oil?
We're looking at 150 first and 200, and maybe even more than 200. Beyond 8 weeks, it could go anywhere. And there will definitely be an impact on the global economy. So we have, if you again look at the 400 million barrels lost every month, 3 months is 1.2 billion barrels lost. And if the IEA wants to release, and IEA is going to release some more oil in middle of April, it's not going to be enough. So the market will choke, and the prices will go up, and it then doesn't matter what the president says on the political front.
So the oil prices that we're seeing currently not quite reflecting the risks in the oil market, correct?
Absolutely. And there are, it's interesting in the market today that if you want all the prices that you list here on the screen is for delivery 60 days from now. If you want to get it right now today, you have to pay $10, $15 extra on top of it. So actually immediate oil is more expensive than oil which comes in 60 days. And if it's 30 days, it's $10 more expensive. So the immediate oil availability is a big problem, and this becomes bigger and bigger and bigger a few weeks down the road.
We had President Trump talking about obliterating Iranian infrastructure, including Kharg Island. Talk to us about whether or not that could possibly create a new energy shock.
Well, it would. He has been talking about occupying the place. Obliterating, attacking it now is recent. As Dan says, every day is a new story. I don't think there is any possibility of him attacking the Kharg Island oil facilities, but he can occupy it and try to use it as a bargaining chip, that you open the straits and I'll give you this back. The problem is that in Iran, there is no central leadership. So many of these commanders which have been killed have not been replaced. There is a lot of decentralized decision-making. People make decisions. They hit the Kuwaiti tanker in Dubai. Why? What is the logic of that? We can be looking for an organized plan. This is a disorganized, chaotic mess. And the Revolutionary Guards just do whatever they want. Somebody's asking for $2 million. Somebody's asking for $1 million. These monies are not going to go to the government pockets. They go to their own pockets. So it is, if you tell them that I'm going to bargain with you, they may say, we don't care. We don't want to do it. So until there is an organized government in Iran, there is no need and no possibility of a logical negotiation.
How should oil importers, especially those in Asia, reliant on the supply from the Middle East, the likes of Japan, India, Korea, how should they be looking at their oil supplies now?
Well, there is a big problem. The issue is that these countries they have shown no backbone. And the same with the Europeans. I mean, the Hormuz Strait closure is everybody's problem. And the fact that they want to charge fees and they say anybody who is a U.S. friend cannot go through here is everybody's problem. And everybody needs to participate. They say this is not our war, it's Trump's war. Let him do it. And it's just not good enough. I am sure if this continues within two months, 8 weeks, there will be allocation of gasoline, even in Singapore. We won't be able to go and fill our cars the way that we want it. Everybody has to begin to ration. This rationing of supplies becomes the norm. This is a big global crisis, and it has to be, the Strait of Hormuz has to be opened. There is no choice.
Some interesting stuff. That's from Faridun Fesharaki, who is the chairman emeritus at an outfit called FGE Nexenteca, which is a global chemical and energy consulting firm. He was talking to our Bloomberg partners. Coming up, authorities in Canada warning of fraud as the FIFA World Cup approaches. There's a new warning about fraud schemes tied to the forthcoming FIFA World Cup. The tournament is hosted by Canada, the US and Mexico, and it's drawing near. Let's get more from CTV's Scott Hurst. Scott, tell us what the authorities are worried about, please.
Andrew, good morning. Of course, excitement is growing for the FIFA World Cup to be hosted here in North America, with both Toronto and Vancouver hosting matches for the World Cup, including games played by Canada. And we've seen demand already skyrocket. According to FIFA, there were more than 500 million requests for tickets submitted as part of a random selection draw that ran through December and January. And now we're hearing from the Canadian Anti-Fraud Centre warning to be on the lookout. Of course, if there's any event that is incredibly popular and has massive demand, you can expect scammers are also looking to take advantage. We saw it during the Blue Jays playoff run. We saw it during the wildly popular Taylor Swift shows as well. So the Anti-Fraud Centre says it's currently tracking frauds related to fraudulent ticket sales, short-term rental fraud, the sale of counterfeit goods, and fraudulent travel services. So there are some ways to protect yourself. Buy tickets through FIFA ticket sales. Be wary of listings that have a price that is too good to be true. Verify short-term listings. And when possible, Andrew, use your credit card, because it can often offer fraud protection. So a few little tips right there to make sure that you don't get caught up in fraud during the FIFA World Cup.
Thank you very much. Our colleague at CTV News, Scott Hurst. We have got the opening bells coming your way after this. Opening bells. Now, at the NASDAQ, Apple is doing it remotely from California. Tim Cook is somewhere in the mob there. I think he's right at the front. That company celebrating its 50th anniversary at the New York Stock Exchange. It's Hershey Company, the chocolate giant, doing the honors. And in Toronto, it's Lightwater Partners celebrating the launch of its first ETF, the All-Canadian Oil and Gas ETF. And I'm sure Joel Haas is there. He's a frequent guest from Lightwater on BNN Bloomberg. It's time for the first 50. And let's check in on the stock market before we get going on individual stocks here. And you can see the TSX is pushing higher as we end a rough month for investors and a rough quarter. You can see the S&P 500 also higher, but markets down 7% and more so far in 2026. But there are hopes, of course, that we're going to be seeing, we'll see the U.S. pull back on its attacks on Iran. But that was interesting. We heard commentary there that who are you actually negotiating with in Iran? Because that Revolutionary Guard is a power unto itself. So it raises questions of who is actually in charge in Iran. Some stocks of interest, Suncor. Let's have a look, because Suncor holding its investor or publishing its Investor Day presentation. Among the highlights, the company is boosting its buyback to a projected $4 billion for 2026. And it sees a cut in its corporate WTI break-even price of $5 by 2028. And so it's increasing annual share repurchases by more than 20%. And we are going to hear from the company's CEO tomorrow on BNN Bloomberg. So watch out for Rich Kruger. We're planning to run that interview at 10:30 a.m. Eastern Time tomorrow. Let's head south of the border for some movers. And we're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities Team. Constellation, thanks for joining us, Jeff. Constellation Energy has been a darling electricity generator, but the share's falling?
Yeah, you're absolutely right. It has been a darling, and maybe it came into this quarter with some pretty high expectations. The shares were falling pre-market. This was one of the worst performers in the S&P 500. In the pre-market session, definitely worth watching over the course of the day today because it is getting knocked pretty hard, down 4% in the pre-market session. The crime here supposedly is that they came out, the guidance was a little bit lighter than expectations at the midpoint. Midpoint of guidance was about $11 in operating EPS for the, or $11.50, pardon me, at the midpoint. That was below about $11.72. Now, offsetting that, you also had better than expected, a few other better than expected items, including they intend to repurchase up to $5 billion of their shares this year. That's an increase from previous amounts. And they're also looking at 20% earnings per share growth between 2026 and 2029. So those two factors, I guess, not quite enough to offset the bad news of the earnings miss, but this may be a case where, as you mentioned, this has been a darling. This stock has been one of the key beneficiaries of the AI build-out and the expectations for more power needs as a result of the AI build-out and the data center build-out. So there were probably much higher expectations here, and you have an earnings per share outlook in the near term that didn't quite reach what Wall Street had expected.
And Marvell Technology shares higher. NVIDIA investing in that company?
That's right. NVIDIA is going to invest $2 billion in Marvell Technologies and also, I guess, embark on a partnership that would help Marvell link up with some of NVIDIA's own facilities. The stock is up sharply. The stock was up 9% in the pre-market session. It's worth watching over the course of the trading day because we have seen NVIDIA invest in and take stakes in other technology companies, and including other chip makers. In the past, they did so with Intel. And we've seen kind of sharp reactions from these chip makers and from those other tech companies as a result. This is one where you are seeing a big lift, and it's worth watching whether or not that kind of stays as it is. Semiconductors are the biggest component of the S&P 500 technology index now, have been a key driver of the rally, and have been under a little bit of pressure. So the semiconductors is a sector within the S&P 500 or a subsector within the S&P 500, which is being very closely watched right now because of some of the pain in the market. Semiconductors, the market really needs those to hold in there.
Jeff, thank you very much indeed. That is Bloomberg's Jeff Morgan. We have lots ahead. March on course for a record, the largest monthly point decline in the history of the S&P 500. Will April be any better? We'll drill into that after the break. There's a look at the North American markets. They are rallying today, but it's been a miserable month. The worst, apparently, on record for the S&P 500 in point decline terms. Of course, it's not quite over today. We're joined now by Carol Leibel, CEO of Domini Impact Investments. Carol, thank you very much for giving us the time.
Good morning. Thanks for having me.
Are you focused on the Strait of Hormuz? Is that really the crucial determinant for markets in the near term, do you think?
Well, yeah, I think the focus is really more on the uncertainty. We certainly know that markets don't like uncertainty, and places people are going to find pockets of value as the duration of the war, the extent of the impact on energy prices, and the direction of interest rates are all things that we're focused on.
And you have coined the phrase March misgivings. Investors develop serious misgivings, doubts, fears even during the month. People had hope for a decent year economically for the US in terms of growth, but that's under a shadow now with this gasoline price, for example.
Yeah, we sure internally have dubbed March misgivings, and sort of looking ahead, hoping for some April awareness. But in March, as you say, the headline news, war and gas, but really that investor shift, January and February, markets were pretty optimistic about growth, and seeing that shift as we began to question whether there would be interest rate cuts, what would be the impact on growth as energy took its bite, and really the consumer. We had good hope for the consumers with some larger than normal tax refunds and maybe having some extra money to spend to spur growth. But a lot of that was really muted with the outbreak of the war. And, as we see consumers spending those extra dollars really at the gas pump and at the grocery store. So, hoping for clarity through April and hoping to shift from misgivings to awareness.
You have an idea for us, a stock idea. Comfort Systems, the ticker symbol is FIX. They're active in cooling, building control systems. And you think they do stand to be a winner from the AI build out?
Yeah, so, we are long-term investors, and we know, in periods of war, disruption, uncertainty, there is volatility that impacts some of these stocks. Comfort Systems really being focused on mechanical, electrical, plumbing. In the industrial space, about $44 billion in market cap, and you can see here some pretty spectacular one-year returns, but you can also probably notice there's been a pullback of about 11% over the past month. So this is a stock we like as we look out on those secular growth trends. And this is a company that's really shifted itself from, an HVAC company to really building system construction and recurring service company. So, growing their modular offsite fabrication really suits them very well for a lot of building needs in the industrial space. By using this modular technology, they're really able to build in a controlled environment, which helps them to better control quality, avoid weather delays. Really, and if you think about data centers where there's often, as they're building out, very congested job sites, the fact that they can move all of this labor offsite is really quite an advantage. So a sweet spot of data center build outs, but also really, with the data centers, we know there's a nice runway ahead with the hyperscalers, committing $700 billion in CapEx there, and a lot of that going to those data centers. Comfort Systems has been able to build a substantial backlog there of about $12 billion.
Wow.
They're increasing that modular capacity build out from about 3 million square feet to 4 million square feet, which is a 30% increase. But data centers isn't really the only industry that can make use of this. Their services, really, we see them involved in education, healthcare, and government as well.
Sure.
So you take all of these, but then you also couple it with, the quality of their balance sheet. So strong balance sheet, cash rich, low debt, excellent execution, a management team that has really proven that they can execute, hitting record levels on revenue, earnings per share growth, and margins, and increasing their dividends as they go. So, a little bit of bumpy, as you say, through the misery of March, but long term, we think a really solid pick.
And then we're tight for time, but a similar story, I think, Quanta Services, big in electricity infrastructure.
Yeah, so, electrical specialty contractor, really another $44 billion backlog. Really, what we love there is that they're in these long-term contracts with hyperscalers and utilities and have those solid financial metrics as well.
Thank you very much, Carol. Really appreciate it. Carol Leibel, CEO of Domini Impact Investments. Yesterday on Market Call, we were joined by Dan Rahinton, Vice President and Portfolio Manager at IA Global Asset Management, and he was covering Canadian and global large caps, and his top ideas were Microsoft, Taiwan Semi, and Visa. And today on the show, it's Mike Vanoke, our Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners. And he will be taking your questions on North American large caps. Up next, we're going to tell you about the pain at the gasoline pumps and how high fuel costs are causing Canadians to cut back on expenses so they can fill up their tanks. Canadians are cutting back not just on traveling, but also other spending so they can afford higher gasoline prices. Now, the Iran war has been pushing up fuel costs, but so will the switch over to summer gasoline. Some countries are coming up with ways to reduce the pain at the pump. Here's CTV's John Venevali-Rao.
With drivers continuing to feel the squeeze, many worry the cost of that fill-up will keep on going up.
We have nothing to do with the war, but we're paying for it. Painful,
In Toronto, gas is back above $1.70, and some hoping politicians will soon step in to offer some relief.
The gas is too expensive now. I don't like it, so I plan to change to the electric car now.
To drive down the pressure at the pumps, in some parts of Australia, states have made public transportation free. The country's tax on fuel and diesel is also being cut in half for 3 months.
We understand the cost pressures for people are very real as the impact of the war on the other side of the world plays out right here.
Italy's Prime Minister also moved to temporarily cut a consumer tax on fuel. And the Canadian Taxpayers Federation is pushing for governments to offer up the same here.
The least they could do would be to temporarily suspend their fuel taxes, but they should be providing real full-time relief.
The group noting the federal government charges an excise tax of 10 cents per liter for gas, 4 cents per liter on diesel. Provinces have their own fuel taxes, and there's GST added.
Some of these taxes are very painful. If you look at places like Vancouver or Montreal, taxes are costing up to about 65 cents per liter of gasoline.
With the war in Iran now into its 5th week and oil prices again climbing, the federal finance minister was asked if the government would cut fuel taxes like Australia.
We're following the situation very carefully.
The minister wouldn't say, while noting Canada is increasing oil production.
Meanwhile, other countries like Spain, Portugal, and Ireland have also cut taxes on gas and diesel, at least temporarily. John Venevali-Rao, CTV News, Toronto.
Meanwhile, in the United States, average gas prices, or the national benchmark, has topped $4 a gallon for the first time since 2022. And that could be politically bad for the Republicans. Ottawa and Ontario have come up with some ways to cut the cost of buying a home. There has been what's billed as a major agreement on housing, which Ontario's Premier, Doug Ford, calls historic. CTV's Annie Bergeron-Oliver has more on what it means for you if you're in the market for a home.
Ready?
After 6 years living in a suburban townhouse, Brittany Ronick is ready to upgrade to a bigger home with more space to play catch.
We wanted something with a bit of a bigger backyard and just room to grow. So we're choosing...
Ronick has a new build and a lot all picked out. The only thing she's waiting for is the government's promised tax relief measures to officially take effect.
As soon as we heard this announcement, it was like a feeling like we won the lottery. Like, wow, now not only can we absolutely move forward with purchasing the new home, but we are going to really make it feel special to us.
Starting April 1st, the Ontario and federal government are removing the GST, HST on the purchase of new build homes. For properties valued up to $1 million, that's a 13% savings, or up to $130,000. On homes between $1 million and $1.5 million, the rebate maxes out at $130,000. For properties $1.8 million and over, it's a max of $24,000.
We got to keep taking action until we get the desired effect of getting the market going again.
Ontario and the federal government are also committing $8.8 billion to help pay for infrastructure projects, so municipalities can reduce development charges by half for 3 years.
They've increased a massive amount over the last 25 years. So the City of Toronto, they've increased by over 5,000%.
The Conservatives doubt the temporary changes will lead to lasting results.
Developers will see this as a good start, as something that will help get things moving again. The problem, of course, is that what's missing is, as I said, some long-term commitment to reducing this expense.
Okay, we are going to have more on that cut in municipal housing levies and so-called development charges shortly. Let's have a look at the gold stock here. Gold and silver rallying pretty sharply today. And we are going to be speaking to the CEO of that company on commodities this afternoon. That show beginning at 3 p.m. Eastern. Now, according to Bloomberg, profit in the latest quarter did miss estimates, but the fourth quarter silver production topping expectations, however, 1.37 million ounces, narrowly ahead of expectations. And often, quarter by quarter profit is not that important to investors in gold and silver stocks. They're more interested in growth and costs over the longer term. Anyway, we hear from the CEO of Aya Gold and Silver this afternoon, Benoit Lassalle, and the show commodity starts at 3 p.m. Eastern. Coming up, we will dig into the latest GDP figures, which indicate that Canada's economy grew modestly at the start of the year. Canada's economic output edged higher at the start of the year with a 0.1% expansion in January. And the estimate is that February saw an increase of 0.2%. Let's get more from Bloomberg's Eric Hertzberg. Eric, thanks very much for joining us. What were the salient points? What were the most interesting things in the economic report for January?
Hey, Andy. Well, I think what you see is the oil and gas sector is starting to come online pretty strongly as a driver again here. Mm-hmm. I think that's important in the context of what we have going on now in terms of higher oil prices amid the conflict in Iran as well. This is something that's going to continue to be a major source of growth over the coming year. I think when you take everything, when you combine all the data that we have, that we got today, you see growth tracking approximately where the bank had expected it to, which is between 1.5% and 2% for the first quarter of this year. Now recall that follows an outright contraction in the fourth quarter of last year, and policymakers have warned of choppy growth. So this is what we're seeing here: is one quarter becomes a negative or a flat, and then you have the next quarter shooting up. And a lot of this fit and start activity is due to, what's going on with the auto sector and other tariff hit sectors. So you do see that appearing in the data right now, Andy.
And apparently the economy now on track to grow by 1.5% in the first quarter. But I think that assumes a flat number for growth. So that looks like it's slightly higher than the analysts were expecting, the economists were expecting.
Yeah, that's higher than what the street is expecting for sure. I think what we have to keep in mind, though, is that in recent months we've also had weak labor activity, and the bank has been particularly focused on some of the downside risks to the economy. And if you look over the course of the year, what economists expect for growth this year is between 1.1% and 1.2%, which is actually quite weak. So if you ask the Bank of Canada right now, they'll see this report is probably roughly in line with what they were expecting in the quarter. But overall, we still have excess supply in this country. The economy is quite weak. And we're about to experience more of the shock from oil. Oil prices are up in this country since the beginning, or gas prices are up about 40% since the beginning of the year, Andy. Wow. And that's going to cut into consumption. And at the same time, we may get some boost in terms of economic growth if that translates into higher output from the oil fields. But that can take time.
That's interesting. Yeah, well, our colleagues at CTV News reporting that consumers are cutting back in other areas in cases where they have to spend a lot of money on gasoline.
Yeah, it's hard to say. I mean, what the bank's worried about now, obviously, Andy, is that you're going to have this effect where it cuts into your consumption, right? We, as households, have to budget for this higher gas price. It takes a chunk out of what we're able to pay and spend on other things. But at the same time, it's also inflationary. So for the central bank, it's quite difficult. Macklem called it a dilemma because there's no clear policy path. That's why it seems as though they're going to be on hold for most of the year, is the expectation of most economists.
Eric, thank you very much indeed. Eric Hertzberg of Bloomberg. We've got lots more ahead. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canada's GDP edged up 0.1% month on month in January, driven by strength in goods-producing industry. There were gains in mining, quarrying, oil and gas extraction, construction and utilities. It did more than offset a contraction in manufacturing. Retail, trade and finance and insurance saw increases. Preliminary data point to a 0.2% increase in February. The euro area has posted its steepest jump in inflation since 2022 as the Iran war pushes energy costs higher. Consumer prices rose 2.5% in March from a year earlier. Governments and central banks in the region are slashing their projections for economic growth, and companies are bracing for a hit to demand from consumers. The European Central Bank is expected to make a decision on interest rates next month. In a social media post today, U.S. President Donald Trump says countries short of oil should either buy it from the U.S. or go to the Strait of Hormuz and take it. Trump also reiterated his disappointment with what he says is a lack of support from allies for his war in Iran, telling America's partners that they'll have to start learning how to fight for themselves. This comes as U.S. and Israeli attacks on Iran and Tehran's retaliations across the Middle East continue to damage energy infrastructure. And there is a look at the TSX posting a handsome gain of almost 2% today. The big movers right now, or the big heavy traders, include TC Energy, the pipeline giant. It is edging higher, about 0.5%. Power Corp up around 1%, and Suncor up around 1.4%. It's talking about stepping up in share buybacks, cutting the price of WTI, at which it earns a profit. And just a reminder, we are going to hear from the CEO of Suncor tomorrow. And let's have a look at the U.S. markets, see how they are faring. You can see they are putting in a pretty decent showing today, but it's been a rough month, March, for investors in Canada and the U.S. and around the world. Big traders right now in the States include Micron Technology, slipping about 1%, and NVIDIA up about 2%. So U.S. President Donald Trump signaling that he is, in fact, willing to end the U.S. military campaign against Iran. Our guest says the implications and effects of this war are only beginning to be felt, and they go far beyond just the price of oil. We're joined by Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Ryan, always great to see you. Thanks for joining us.
Thanks, Andy. Good to see you as well.
I know it's impossible to answer in the sense that who knows where this military situation is going to go, but how are you playing things right now?
Well, we were well prepared for this in advance. We always try to build the portfolio to be resilient through all types of environments. And I was looking back, it was 2024 when we first outlined our thesis on energy and especially natural gas demand. And that's only been heightened by this conflict. So when you look at the damage to the Qatar LNG export facilities, it's material. And so longer term, what makes us excited or at least optimistic in Canada is our ability to bring on additional LNG export capacity that should now have a bit of a scarcity premium. We have low cost gas. We have the shorter shipping route to Asia. We have a lower ambient temperature, which requires less and sort of cleaner energy to cool the gas. And now we have supply certainty, or at least better supply certainty than what will now be questioned for decades into the future as a result of this conflict.
Have you made change with this surge in energy prices? Have you made any significant changes to your portfolio?
No, we're happy with how we're positioned. We are now looking and maybe crossing our fingers and hoping for a little bit more weakness in some of those sectors that have been more richly valued, like consumer, industrial, and healthcare. Where we're kind of short, where we don't have a big position in the portfolio. So that's what we're looking at. Nothing done yet, but still very happy to hold those energy infrastructure companies because, as I mentioned, if you're looking at TC, Pembina, Enbridge, AltaGas, those assets now, which were viewed as stranded coming out of the 2021 kind of energy decline related to the pandemic, are now, we think, are premium assets globally.
Yeah, I mean, look at that. TC Energy losing a little bit of altitude today, but Pembina Pipeline higher in trading today. Yeah, I mean, this does put a shiny light on Canada as an energy source.
Yeah, and it's an opportunity for us, right? So we had one opportunity, and now arguably the opportunity we squandered about a decade ago is really costing us now. We could be exporting 5, 6, 7 BCF a day of gas at $18 an MCF. We're missing out on that opportunity today, and that's only as it relates to a political climate where this was called uneconomic by our leader at the time. So that's unfortunate, but when a window closes, a door opens, or maybe I have that backwards. But now we have another opportunity here, and so there's work being done right now on LNG Canada Phase 2. I would expect a final investment decision to be forthcoming. We need more global ports of supply, secure ports of supply, and I think we now hopefully have the political will to get something done.
We've got a deal. I mean, the tech industry does like these complicated embraces, doesn't it? You sign a big contract to buy a bunch of chips from somebody, and lo and behold, they're investing in you. And we've got NVIDIA now buying into Marvell Technology.
Yeah, and I challenge anyone to go and read that press release and try to understand all the acronyms and terminology included there. Now, I won't claim to be an expert on compute, to put it sort of generally. But what I would say is, just looking back at history of these types of technological advancements, it's the hardware producers that lead, but then it's the applications and the software that end up eating most of the profit. And so NVIDIA is still $5.5 trillion market cap in Canadian dollars. And the reason I use Canadian dollars is because it's nearly $1 trillion higher than the entire TSX. I just don't see that as being sustainable. When you look at NVIDIA as well, they are selling these chips at a rapid rate right now because the demand for compute is in theory unbounded. But what is bounding it, and what is bounding it even more tightly now with this Middle East conflict, is energy. And so I would be not surprised to say that I think it's highly likely that a significant portion of the NVIDIA chips bought to date have not been deployed and will not be able to be deployed in this environment, given construction backlog and what it takes to get a data center hooked up to the grid, utility transmission backlog. Like, there is a huge physical world constraint here on NVIDIA's growth. And I think the Middle East war only heightens that. So they can do all these deals that they want. They definitely have the cash. They definitely have the equity currency in terms of the willingness of people to do deals with them. But if you look at the stock price, it's been flat since last summer. We're 9 months now, and it actually looks like it's breaking down. So I would be very, very wary of this company specifically as it goes forward here in the next, call it, 12 to 36 months.
That's interesting. You think that some of these NVIDIA devices maybe just end up sitting in their boxes gathering dust on shelves?
Yeah, I think it's highly likely. If you look at any person who in the utility business who's talking about connecting one of these data centers to a grid and getting them connected, the backlogs are into the years. Okay, so the front running of demand has happened. There's a scarcity element here where people are looking to lock in the chips because that's what's scarce and they want to be ahead. And there's this sort of arms race in the technology sector. But the physical deployment, if you look at the construction timelines of these things, is like I said, in the years, and that's even if you can get a grid connection in the first place. So I think it's highly likely that we're overbought here on chips, and it would be not surprising to see demand start to ebb, 2 or 3 years out, especially in a world where the world is now trying to rationalize, hey, what does it cost me to get more oil production in a world where oil production is now more scarce? What does it cost me to get more aluminum production? What does it cost me to get more natural gas production? And weighing that against, building more data centers, that this is now a different world we're living in post-Iran conflict in terms of prioritization.
Ryan, thank you very much indeed.
Thanks, Andy.
Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Coming up, the federal government in Ontario are investing almost $9 billion to help cut real estate development charges imposed by local governments. We're going to hear from a developer after the break who says this is a promising first step in ending the housing crunch. We'll be right back. The federal government in Ontario say they're investing almost $9 billion in infrastructure over the next decade as part of an initiative to encourage municipalities to cut these real estate development charges that are blamed for pushing up the cost of new housing. Our guest says that this is one of the first policy moves that fixes the math for developers to start getting more homes built. We're joined by Adrian Rocca, CEO and founder of Fitzrovia. Adrian, thanks very much indeed. It is almost $9 billion, but it's over 10 years. But you think this will be a help anyway?
It's definitely a step in the right direction. We've been advocating with all three levels of government that we have to fix the math equation to get more development kickstarted. Depending on what data you look at, new starts are down 50 to 70%, and a lot of that was driven by the math simply did not work. So it's definitely a step in the right direction. We would have loved to see a full waiver of development charges, but a half waiver is certainly an improvement.
Just remind us what these development charges are, please.
Yeah, so development charges are basically a statutory charge that every developer has to pay. If you look at the total fee load, municipal fees, government fees, levies, it's about 30% of your total development costs. A portion of that would be development charges, and then you have parkland charges and community benefit charges and things like that. So that it was meaningful. And so if you actually look at the 50% waiver, it's about 3% of your total development costs now gets pulled out of your total math equation. That's a benefit. It's about 300 basis points on your development IR. So that is meaningful. Now, rents in Toronto are down, net effective rents are down 21%. So about face rates are about 11 to 12%, and then concessions get us up to about 21%. So it doesn't get us all the way there, but it's certainly an improvement.
Give us that math again. Start off, development charges are typically how much of your cost base, and I think you said this is going to be a 50% cut. Can you walk us through it again, please?
Yeah, so if you look at just the development charge component, it's about 6 to 7%, depending on what cities you're looking at, jurisdictions you're looking at in Ontario.
6 to 7% of the cost of building a unit.
Correct. That's right. And so it would be an implied discount now if 3% gets pulled out of your total development cost budget, and that basically translates into about 300 basis points, 3% of your development IR.
Right. So it doesn't, to someone like me at first impression, it doesn't sound like it's a huge, I thought the development charge impact on new homes was much bigger than 6 or 7%.
No, it's about 6 or 7% of your total development costs. The number that gets quoted pretty widely is what is your total fee load related to government charges, but those government charges are also parkland, which would be, plus or minus. It used to be about 10% of your total assessed land value, or community benefit charges as well. So collectively, that property tax, et cetera, would be about 30%. About 7% of that would be development charges. Now, that will jump around depending on what city you're talking about, but call it 6 or 7%.
That's interesting. So it's really only a portion of these various fees and costs that governments load on that are being reduced here.
That's right. And there was a policy change a couple years ago where development charges were actually deferred. So basically it's stretched over 6 years in equal installments once you complete the building. So there is still a significant benefit, but some of that benefit was offset by the deferral, which was introduced a couple years ago.
And sorry to make you repeat yourself, but I just want to get it straight. What are these other costs that governments load on? Are they all municipal or some provincial, for example?
Yeah, so a lot of it would be municipal led. So they used to have what's called the Section 37 regime. It then got changed into what's called a community benefit charge. So this would go towards schools, libraries, et cetera. So these would be special projects in the jurisdiction that you're developing in. So that'd be one component. So that would be to the benefit of the community. Another component would be a parkland charge. So if you can't basically provide an on-site park, there's a cash in lieu component that needs to get paid to the city so that the city could fund the build out of parks. Those would be two kind of larger sums which are unaffected by this announcement.
You guys build rental housing. That's your game. In Toronto, this decline, you said there was a 20% decline in effective rents. That's going to hurt your economics.
It does. So there has been a significant amount of supply that is being delivered on the market. And so at the tail end of COVID, you basically saw 2 times the long-term average of supply or starts that got kickstarted when interest rates were at an all-time low. So if you look at Toronto right now in the next 12 months, there's about 30,000 rental units that are forecasted to be delivered on the market. That compares to the long-term kind of average of 15 to 17,000 units. However, if you go beyond 12 months, that drops to 17,000 units in year 2. It drops to then 7,500 units in year 3, and it drops to 3,500 units in year 4. There's nothing that will structurally change those numbers, right? We know we're going to have a housing crisis purely with the lack of supply in 18 months from now.
Thank you very much, Adrian. It's always great hearing from you. Adrian Rocca, CEO and founder of Fitzrovia. Up next, we are going to zero in on 3 Canadian ETF ideas. Stick with us. Time for the ETF report. We are going to zero in on 3 Canadian ETFs, and we're talking to a major provider of ETFs in Canada. We're joined by Christy Akulian, head of iShares investment strategy for the Americas at BlackRock, a giant player globally in ETFs. Thanks very much indeed for joining us.
Of course. Thank you for having me.
Just give us an idea of the scale of the ETF business in Canada or the US and the amount of trading, for example, that goes on through ETFs these days.
Yeah, and as you noted, ETFs are enormous globally. A couple stats that I found interesting, even just sort of from the recent, some of the recent geopolitical tensions, some of this more uncertainty in markets. One of the things that we zoom in on is looking at kind of the scale of ETF trading relative to just the entire stock market. And here in the U.S., we've had the largest month on record so far in March, with today left to go, I guess. We're about $4 out of every 10 that were traded in the U.S. stock market changed hands via ETFs.
Wow.
So we're just seeing an enormous amount of trading as investors really reach for this vehicle or this tool in their portfolio that is liquid, that's efficient, and that allows them to change and adjust portfolios to kind of changing market conditions quickly.
And you guys, how long have you been offering ETFs in Canada?
I know, the first ETF ever was launched in Canada. And at BlackRock, we have a long history going back decades as well of being able to offer ETFs in Canada as well.
Right. Well, let's talk about a couple of your products here. There's the ex-US. Let's start off with that one. It's the iShares Core S&P 500 Index ETF. Is this a popular product with investors? What can you tell us about it?
Yeah, absolutely. And this is, it's a standard building block of many investor portfolios, given that it is a core exposure. I think right now in the market, people are feeling fairly uncertain given the conflict in the Middle East, given prices of oil and what that can mean for the global economy. But what we're seeing in terms of some of the relative strengths is that we're seeing, the U.S. equity market is relatively resilient. Mm-hmm. And in fact, we've actually seen earnings estimates being revised higher over the month of March, even considering some of that conflict and, again, volatility and uncertainty. So I would characterize us as being sort of, tactically cautious, mm-hmm. given some of the volatility, but structurally we're much more bullish there. And so some of the revised earnings upward in tandem with some of the prices coming down have actually meant that we see PE multiples actually below their 5-year average mm-hmm. in the U.S. So we're, I think coming into the year, even though, there was some acknowledgement that some of the strongest earnings growth was coming from U.S. equity markets like the S&P 500, what concerned most investors was really just around the valuations. So some of that has been addressed, right, in terms of those valuations trading much lower, but we're still seeing that strong earnings growth and something that can really pair well with a portfolio of Canadian equities that I know many Canadian investors hold, because you're getting more of that growth aspect than you might be getting in some of the Canadian equities.
Right. So this one tracks the S&P 500. It's huge. It's almost, the latest number I have, almost $11 billion. And of course, as with the S&P as a whole, the latest breakdown I have is about 32% in infotech. Let's get on to another one, XFLX, the iShares flexible monthly income ETF. And this is hedged to Canadian dollars. Who is this aimed at?
Yeah, I think this is for investors who are looking for income. And really, when we think about the fixed income side of a portfolio right now, we are more focused on income than capital appreciation. We don't expect rates to come down a lot. I think income is a really, it's more of a sure thing in an uncertain market. And really specifically, what XFlex does is it features and focuses on some of the plus sectors. So some of the areas of the fixed income market globally that may be harder for investors to access access themselves. So think of things like global credit, looking at some of the securitized and asset-backed securities, and really being able to tightly manage some of that duration. I think what's really special about this fund is that it can be a very nice complement to core bond holdings that many advisors and other investors who may be focused on retirement or longer term goals may be holding. And so XFlex can pair nicely with that core bond exposure, but it is actively managed. It does reach some of those harder to access parts of the market, and it really specifically manages sort of the duration exposure because, again, we don't want to take a huge amount of risk and duration if we're really focused on income and where we can get that in this type of environment.
Right. And a lot of it's in the US. Non-US credit is about 17%. And a trailing yield, and I know yields can be calculated in multiple ways, but the trailing yield of about 5.7%.
Yes, that's correct. And this fund, that will move around a little bit because it is actively managed. It's managed by Rick Reeder, our global CIO for fixed income here at BlackRock. So that'll move a little bit. But again, that focus on income, that focus on complementing the core bonds that you may already have in your portfolio.
Right. And then let's look at the final one. It's XEC, the iShares Core MSCI Emerging Markets ETF. Now, higher energy prices are bad for stock markets generally all around the world. But tell us, who is this fund aimed at?
Yeah, and you're exactly right. And I think that it warrants some amount of caution. I think this is definitely sort of outside of the consensus trade right now, given how some of those higher energy prices can affect, or how some of the Asian economies, particularly in the EM basket, can be more exposed to some of those higher oil and energy prices broadly. But really, what we have seen benefiting emerging markets lately over the last year or so has been really strong earnings growth that has been part and parcel of the AI theme. So for investors who still want to access the AI theme, but maybe are worried about the concentration that they may get in U.S. indices or some of the Magnificent Seven, for example, I think emerging markets has really proven is where, kind of the next leg of some of this emerging market or some of this AI trade is really flowing through, whether it's economies like Korea or Taiwan that are really involved in some of the manufacturing. And what that has meant in terms of performance and really the index more broadly is that we've seen incredibly strong earnings growth coming from emerging markets, even higher than we're seeing in the U.S. And so, again, near-term caution is certainly warranted given the situation with oil and energy prices. But if we look at our polling data from clients across the Americas over the course of the entire year and last year as well, emerging markets was actually identified as the place where most investors were keen to add to before the start of the conflict in Iran. So, if we do see a resolution, if we do see energy prices come down, we believe that some of that more enduring trend of allocating to AI, but in maybe a more diversified way, can continue. So I think this is for investors who, again, want exposure to AI at lower multiples that you're getting in developed markets and maybe at adding a little bit more diversification to what you may be getting in North American equities as well.
Thank you very much, Christy. Really appreciate it. Christy Akulian, head of iShares investment strategy for the Americas at BlackRock. Coming up, we're going to bring you the latest headlines and update you on the markets. We'll be right back. Shares in Aya Gold and Silver climbing today, up around 11%. This Quebec-based company that produces in Morocco topped estimates on silver production in its fourth quarter. The company says its operations in Morocco now operating at a steady state, enabling significant cash flow, supported by a strong silver price. Aya is now working on advancing another new mine in Morocco. It's currently undergoing a feasibility study. And later today on Commodities, a reminder, we'll hear from Benoit Lassalle, President and CEO of Aya. We've seen some selling in shares of Unilever and McCormick today. Unilever is combining its food business with spice maker McCormick in a deal valued at almost $45 billion US. This will give Unilever control over the newly formed global seasoning and condiments company. And MC McCormick will pay the Anglo-Dutch company in cash and stock for most of Unilever's food business. Another transaction leaves Unilever and its shareholders with a 2/3 stake in the combined entity. Shares in Eli Lilly and Centessa Pharmaceuticals are trading higher today. Look at the jump in Centessa there. The American drug maker is buying the pharma player in a deal worth up to $7.8 billion US. Centessa is developing drugs to treat sleep-wake disorders, including narcolepsy. Lilly will make additional payments if 3 milestone targets are met. This comes as the weight loss drug giant seeks to expand into sleep disorders. We got a pretty sharp rally in markets after a miserable March. There are hopes that President Donald Trump is ready to end the attacks on Iran, even with the Strait of Hormuz largely closed. The Wall Street Journal says Trump and his team think that a mission to reopen the strait would delay the war beyond his timeline of 4 to 6 weeks. And so the Americans, it seems, according to these reports, are keen to end the fighting. Let's turn our attention back to Canada's economy. Real economic output edging up 0.1% in January, month over month. It was a second consecutive monthly increase. We got insight from Jimmy Jean, chief economist and strategist at Desjardins. He says this is a decent start to the year and shows that the economy has some resilience.
For the month of February, that's where the consensus was looking at for something flat, and then it looks like we may have had another increase in February. So those are good, I guess, starting points for the first quarter and 2026 as a whole.
To that point, given so much has changed in the world since the January data has come out, are people going to look through this number, or is this going to have any impact on the bond market?
I would suspect so, in the sense that the information contained in here will be still knowing what's ahead of us. Now, what's ahead of us in Canada is really different from what's ahead of the U.S. or European countries, for that matter, in the sense that Canada is a net exporter. So therefore, we have a positive terms of trade shock that will boost our Canadian outlook here in Canada, in the provinces in particular that are oil producers. However, in provinces where there are net consumers, obviously this is going to have a similar impact on disposable income, on real disposable income, and on household purchasing power than you have elsewhere. And that's why the Bank of Canada is sort of in a bind here. The next few numbers, I think, will start to give us a sense. But I think by way of really getting some traction in the oil sector, by way of production and those things, it might take a few months. So we might observe it more over the course of a quarter or so.
Yeah, we saw, just looking at the numbers, oil and gas was up 1.6%, offsetting December's contraction. Does that bode well heading into the next couple of months of numbers?
Right. I think it's a sign that it's an industry that's been one of the more resilient one. We have to remember this is one of the least targeted industries, and for reasons that are pretty obvious, but the least targeted industries when it comes to U.S. tariffs. Same thing when we look at oil-producing provinces. That's where the effective tariff rate is is the lowest. So you don't have the kind of obstacles on that sector that you have elsewhere. But even looking at some of the other sectors that you would typically think would be in difficulty right now. Things like retail are not performing too bad here. So the economy does have some level of resilience. We saw that in the fourth quarter with domestic demand. Even though we had a contraction on the top line numbers, we did have domestic demand actually rising 2.4%. So coming in very strong. A lot of that is heavily influenced by the government and particularly defense spending. So we saw those numbers influence the quarterly data. I think it's something we're likely to continue to observe as those announcements regarding defense continue to roll in.
You kind of touched on it, but there's all this concern last year with tariffs and just the threat to the Ontario industrial base and auto manufacturing. Are we starting to see that bite yet in the numbers, or is it still just been something that we've been able to skate through?
Well, I think overall, we're still in a position where those tariff rates affecting Canada compared to what other countries have to deal with, for example, China. Well, Canada is still in a relatively good spot. It's really those sectoral tariffs that have created that pinch in some of those targeted industries, so the wood products industry, steel, aluminum. We know who they are, but overall, once there was that sense of that awareness. That CUSMA was still applicable, and therefore nothing was really changing for the vast majority of exporters. That's where you start to see confidence rising again. Now, exports are still under pressure, to be sure, but you are seeing interest in diversifying and looking for alternative markets to try to gain that resilience. It will take. It's going to be for the long haul. It's going to take some time. We're starting from afar. Exports to non-U.S. countries are just a fraction of our exports, really. But you have a movement of magnitude that you haven't seen in the past. So I think that's looking up. The other thing is that we've seen, the fact that retail came in positive, and we saw the retail sales numbers as well, surprise to the upside. That's a good sign in a context where we have a job market that's been struggling since the start of the year. So we'll have to see the next numbers to see whether that was just a blip and whether we see a little bit of a recovery there. But the fact that retail actually held up gives an alternative view as to the state of the economy and the domestic economy. That's not as bad as we could have feared from earlier numbers.
Now, with the manufacturing compared to the energy, are we in danger of becoming a tale of two solitudes, but more the east and the west? West is the energy, and with the manufacturing taking a hit right now. And how does the Bank of Canada balance those two?
Yeah, it's sort of, and we've been through that before. It's sort of the Dutch disease version 3.0, if you will. But it is a risk at this point because we have to think that the oil shock that we currently live through might be temporary. At least that's what we assume. We have an oil shock that lasts about 2 months, and by the third quarter. Our baseline view is that oil prices converge back to the previous range, the $60 to $70 range. Of course, there's a lot of uncertainty around that. But if it were to last, then you would have that two-track economy indeed, where oil-producing sectors would benefit and manufacturing exposed. The highest effective tariff rate is in Ontario, it's in Quebec, and those economies struggling. Now, the big difference versus the past is that you used to see the Canadian dollar rally when oil would be as strong. Now, we haven't quite seen that, perhaps against other currencies, but against the U.S. dollar, given the safe haven flows into the U.S. that we've seen, we haven't seen the Canadian dollar rally. And usually it's that rally in the Canadian dollar that further harms manufacturing producing provinces. And you're not seeing that now. Okay. But conversely, you have the CUSMA uncertainty that is weighing.
Okay, coming up, we are going to zero in on 3 small-cap U.S. energy stocks. And our guest says there has been a major move up in long-term oil futures. And he says that it's a significant move for the entire industry. We'll have more after the break. On Hot Picks today, we're drilling into 3 small-cap energy ideas. Let's get more from Sean Severson, CEO and co-founder at Water Tower Research. Sean, thanks very much for joining us. First off, you have some interesting thoughts on the oil market. We obsess, of course, about the most heavily traded near-term oil futures contract, the WTI, and that has stopped $100. But you say if we go out over 1, 2, and more years, we've seen a major move up in long-term oil contracts as well. We may have... Sorry, go ahead, Sean. I'm not sure if you heard my question.
Yeah, can you hear me? Sorry, I looked a little unstable there, so I apologize. Yeah, I think what we're looking at here is the longer-term contracts.
We seem to be having trouble with Sean Severson there.
Truly happening in the energy story is told in 26, 27, and 28 futures contracts. And they're all up $8 to $14 since CapEx and development is built on, but it is creating some opportunities out there.
And we lost a bit of that because you were freezing on us. But I think you say that if we look at these longer term contracts, well over a year, we've seen a move of up to $14 higher US a barrel.
That's right. And what it's doing is it's creating an opportunity for companies that are looking at, the cash flows, for example, or ability to delever. That creates an opportunity for, companies that can really increase their cash flow. Because remember, your costs and productions are generally known and fixed, but each time oil goes up, over the longer term, that drops to the bottom line and creates cash flow, which can be used, to delever, pay dividends, or create all kinds of opportunities.
And you say that you're on the lookout for smaller cap oil companies with not too much hedging and financial leverage. That means that a lot of $100 plus oil goes straight into their income statement, or their cash flow anyway.
That's exactly right. And it creates an opportunity to, again, pay down debt, delever. So the optimal situation will be a company that has leverage, but that's unhedged, because really they can de-risk their business by using that cash flow and paying back debt faster than what was originally expected by investors. You've seen this start to be reflected, across the sector, but there's still some real opportunities out there.
Matador Resources is your first idea, Permian operator. What attracts you to this name?
Well, mostly because it has zero hedge exposure. So again, the things you want to look at, unhedged, has debt, or could potentially be an acquisition target. These guys have a great position being unhedged, really, and they have a strong balance sheet on top of that. But really, the cash flow can start to accelerate because they can benefit from these longer-term higher oil prices. The cash flow is expected to increase significantly. So this is the kind of company.
I think we might have lost Sean.
You look for using this as a great example. And again, this one happens to have a good balance sheet.
Okay, we're having a little bit of trouble with the audio, Sean, but let's press on. Magnolia Oil and Gas. What stands out for you with this stock, Magnolia?
Magnolia, sorry, that's the one I got. That was the zero hedge. I thought you said Matador. Magnolia has zero hedge exposure. And so, again, that becomes an opportunity for increased cash flows as you look at these longer contracts that are out there. So, again, a zero hedge exposure is a great opportunity. So looking for investors to look for companies that have little or no hedging is an optimal positioning into this oil market.
Sean, thanks very much indeed. Now, we were having audio trouble, and sorry about that, but really appreciate your giving us the time today. And Sean Severson was our guest there, CEO and co-founder of Water Tower Research. Sorry about those glitches. Coming up, U.S. President Donald Trump telling allies, if you want jet fuel, You're going to have to fight for it. Get it yourself or buy from the US. That's ahead. US President Donald Trump has lashed out at allies for not supporting the US war in Iran. He argues that America will not fight for their interests as they struggle in some countries to get jet fuel that's been blocked from traveling through the Strait of Hormuz. We are joined by Bloomberg reporter Jack Whittles, who focuses on oil, refined products, and shipping. Thanks very much indeed for joining us. Before we get to Mr. Trump's remarks, what's the big picture on jet fuel and the Strait of Hormuz right now, please?
So the big picture is that the countries inside the Persian Gulf are significant exporters of jet fuel and kerosene. Jet fuel is made from kerosene. A lot of that product goes to Europe, but Asia is also particularly at risk because of the situation in the Middle East, because they take a lot of the crude oil from inside the Persian Gulf, so their refiners are having to reduce production. So you therefore have a double whammy hit on the global jet fuel supply. You have a loss of exports through the Strait of Hormuz, but you also have a loss of production at oil refineries that can't make it because they can't get the crude out of Hormuz as well.
And Mr. Trump, he's frustrated. Spain won't let military jets, U.S. military jets, use its runways. Italy won't let them use Sicily, apparently. What is he telling these allies?
Yes. So the situation with Trump, what he's saying, in his tweet, he has sort of suggested that people buy jet fuel from the US to replace what they're not getting through the Strait of Hormuz. That is, the US is a major exporter of jet fuel. It exported about 80 million barrels of kerosene-type jet fuel last year, according to government data. But that is a relatively small amount of jet fuel and kerosene compared to the amount that will be lost if the Strait of Hormuz remains closed. So, for instance, a recent estimate from consultancy FG Next and ECA recently pegged the loss of jet kero from the closure of the Strait of Hormuz at 37 million barrels in March and April. So that's over 2 months versus the US exports of 80 million barrels over a whole year. So the US exports would not meet that. And also, whoever the US is currently exporting to, they still need jet fuel. So it can't easily be replaced at all.
And you may have touched on this, but total jet fuel demand was almost 8 million barrels a day last year. So that's about 8% of world consumption. So that's pretty hefty.
Yeah, it's a significant market, and it's being hit particularly hard by the closure of the Strait of Hormuz. The price of jet fuel in Europe has far outpaced the gains seen in other petroleum products like diesel, ship fuel, naphtha, which is a petrochemical feedstock, and gasoline blending feedstock. So we have hit records in Europe. Europe is probably the next pinch point after Asia. And in Asia, we have also started already seeing some flights cancelling demand, some airlines cancelling flights. But we should also remember that the US is not immune to this problem, even though it does export jet fuel. So United Airlines, they have already cancelled some flights because the prices are soaring globally. Ultimately, it's a global market. The prices are going up. And US airlines are generally not particularly well hedged on jet fuel.
That's interesting. Maybe we can put up a one-year chart for Delta Airlines, DAL, I'm just curious, or United Airlines. Yeah, that's interesting. That's the thing about the oil market, isn't it? It's global. People can switch tankers in mid-journey.
Exactly. We have seen quite a few cargoes of diesel and jet fuel diverting, a lot of them heading towards Asia. So yes, it is a global market. So even if you are an exporter and you have lots of oil, like the US, ultimately companies can sell to wherever the price is highest. So that doesn't keep the prices down in a country, even if a country has a lot of fuel.
Well, I hate flying so much these days with the way you're herded and you're cramped that any excuse to stay on the ground will serve me. Thank you very much. I really appreciate it.
Thank you.
That's Bloomberg reporter Jack Whittles. Thanks very much indeed for watching The Open. Morning Markets coming your way.